For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Well, it sure is Managing Your Financial Future. Welcome back to the podcast. Johnny Dean, your podcast host. Once again, as always, here with Rick, the Professor Plum, certified financial planner professional and accredited wealth management advisor. We're going to talk today about, I look back, we have not talked about these, I guess I'll call them the extra buckets. Rick, we have a standard discussion when we talk about buckets, all right? Generally, we talk about 3 of them, right?
Well, those are the core buckets that, as a retiree, everybody should have. And the reality is, at any age, there is a core set of 3 buckets. It's just that when you're young, bucket number 1, the asset that is providing the income that you're going to spend for the next 1 to 7 years is you. You are bucket number 1. And the bucket number 2 is the asset that is going to provide the cash flow that you're going to spend in years 8 through 15. Guess what? You're bucket number 2 as well. So for the young person, you need to focus on bucket number 3. That's something you don't have. The money you're going to spend way later in life or for longer-term needs. Everybody has a core 3.
Yes. Now, when you say bucket is you, what you're talking about is that you're talking about people in their 20s, 30s, 40s who are still working. The bucket 1 and 2 is your income.
Well, bucket number 1 is filled with assets to provide current cash flow for a period of 1 to 6, 7 years. Guess what asset is providing the current cash flow for that 30-year-old, 35-year-old, 40-year-old? They are. Mm-hmm. Because unless you're just – now, that's not always true. I actually had a review of the client yesterday. Now he's 49 years old, but he's been a client for maybe 15 years. Well, not quite that, but he retired at 36.
Oh man.
And he actually has the traditional more bucket 1, 2, 3 because he was able to, .com guy, retire at 36 with multiple millions more than he needed, man. And because he can.
Well, that's
because
nice.
He could, and he can.
Because he could. Yeah, no, that's good. So that's what you mean by that, and that's true. So we talk about the 3: the money you need, like soon, like now. And over the next 7 years, the money you need a little bit later after that, like years 8 through 15, and money that has time to grow. And for a retiree, that's why we divide those up, the core of the strategy, where most of the retirement income discussion usually lives. But a bucket strategy, well, no, I should say this, the bucket strategy, that's the one that you do, Professor, and all the people you work with. The strategy is nothing if not flexible. It has to be, because we don't operate within strict rules, as I'm sure you've heard us say. There's always some, wiggle room, if you want to call it that.
Well, there's room for individual interpretation. There's room for individual needs that are different from other people's needs. Mm-hmm. There's room for risk tolerance attitudes, emotional attitudes that are different from one person to another. Mm-hmm. So you have to be able to develop a strategy that not only fits the basic, financial fundamentals of things, but also allows for individuality and flexibility, and to satisfy certain issues that some people will have that other people don't have.
Yeah. In fact, these 2 other buckets that we're going to talk about here today probably aren't needed. I'm going to guess. Now, you can correct me, but probably aren't needed by the majority of bucket strategy holders. Am I correct, or is that?
I don't know about majority. I don't know whether it's 40% or 60% or but it's enough that it needs to be discussed for many people. Now, not everybody needs the sub buckets, the subsets. Yeah. But for some people, they are desired and or really should be considered. even if you don't like the idea, it does help in some areas. And
Well, okay. So today, let's talk about what these extra buckets are, what they're designed to do, and when they might make sense and when they might not make sense. Because, as we said, the point of the bucket strategy is not to make things complicated. The point is to make sure that each dollar is assigned a task with a specific goal in mind for that dollar. So let's talk about the first one. I'm not going to call these bucket 4 and 5. Some people do, Rick.
No,
but
I don't like that.
No, and there's a reason for that. Let's talk about. Here are the two. One is, can I call it protected income? Is that okay?
Protected income, lifetime income, yeah.
Yeah, okay, that's one. And then the other one would be alternative investments, and we'll get into that one in just a moment. But let's start with this protected income. And the reason we don't call it bucket 4 is because really, Rick, this whole idea of a protected income bucket separate from the other three is what you might call a bucket 1A. Talk about that, if you would, please.
Well, the idea is we're looking for bucket number 1, as we talked earlier, is to create cash flow. Now, generally, bucket number 1 uses liquid, low volatility, safer type assets that we can spend principal and interest on and create cash flow that we need for the next 1 to 7 years. Protected income is a little bit different. Protected income is a guaranteed income source for the rest of your life. It's not for the first 7 years. It's for as long as you live and for as long as you and or your spouse live. And so the idea is to create another guaranteed direct income source that, regardless of market conditions, regardless of how good or bad of an investor you are, regardless of how lucky or unlucky you are, that money will show up on the same day of the month, every month, come heck or high water. And from an investment standpoint, I'm going to say this right up, and people are going to get mad at me, especially people that sell these. They're not the greatest rate of return in the world, but you're not buying them for rate of return. These are bought to help create a stability of income, and it's to control the emotional aspects of the individual more than as much as anything else. Because what studies have shown, and many studies have shown, if you have enough income from outside sources, guaranteed sources, direct income sources, pension, Social Security, guaranteed income, to cover your expenses, your basic expenses. I mean, when we wake up in the morning, we have expenses. We haven't even had breakfast yet, and we have expenses, whether it be gas and electric, utilities, insurance, basic food, energy, that kind of stuff. We have expenses. Property taxes or rent, even if your house is paid for, you're going to have expenses, maintenance, car expense, all this kind of stuff. It happens. If we have enough income coming in every month to cover all those expenses, we are less emotional about the rest of the world. If the market goes down by 15, 20% in the next month, it's like, oh, wow, that kind of doesn't feel very good. But you know what? I'm okay. And so what studies have shown is that if we have enough income from Social Security pensions and such, we are better investors. And even though we're better, what happens is we don't react to negative news the same way. And so some people have enough income from pensions and Social Security where they don't need to buy or use any of their portfolio to create more guaranteed income. Some people, have Social Security and pensions, $60,000, $80,000, $100,000 a year, and their expenses are $50,000, $60,000, $70,000 a year. They should not consider these lifetime income, protected income type contracts. On the other hand, some people, their Social Security isn't all that great. Maybe they've got $3,000, $4,000 of combined Social Security or individual Social Security, but their expenses, their basic expenses, are $5,000, $6,000 a month. That's the person that should consider this, because we don't want to have what we see is a lot when people don't have enough income and they're relying on their portfolio. When the portfolio goes down, they get afraid. When they get afraid, they sell. They basically hug their portfolio. They put their arms around it. They sell everything, saying, I got to sell off before I lose everything. And then the market usually turns around and right about that same time, and they never recover because now they're at a permanent loss situation, going back to the difference between volatility and risk that we've talked about many times. Mm-hmm. So having protected income for the right person gives us a lot of stability in our emotional decision making. And study after study after study has shown that and as I've said before, even though these are not going to have the greatest rate of return, it allows the rest of the portfolio to do better, to invest better, to have a better rate of return. And actually the legacy, the amount of money that's left over after you're gone, tends to be better if you've set yourself up this way, which is a positive thing. Not only do you have more guarantees, less anxiety, more stability while you're alive, you leave more money to the kids. Oh, darn.
The kids will love that. Okay, so a question that can come up from people, though, is that, well, wait a minute, though. I get what you're saying. That's absolutely true. But isn't that why you have just a bucket one to begin with, like the short-term bucket? What is the difference between those? You alluded to it a little bit ago, but let's just answer that question.
I didn't allude to it, but I'll be more clear. The traditional bucket number one is for spending needs for the next 6 to 7 years. Cash flow for the next 6 to 7 years. And then it's empty, and we have to refill it from bucket number two. Protected income is set, and it will continue at that level for the rest of your life. Now, it's not a 6-7 year commitment. It's a lifetime thing. Now, there are lots of different types of these products. The cash value of these products has a lot to do with what's going on. The insurance company has a lot to do with the guarantee. You're using your own money for the first X number of years as long as there's cash value. But once the cash value goes away, now we're relying on the insurance company to live up to their promise. So we want to make sure we stay with a good insurance company. But how that cash value is invested in the meantime, you could use a variable annuity, which lately, over the last 5-10 years, has done very well if you have the ability to control the investments. Unfortunately, what a lot of variable annuities do is they control the risk of the investments that you choose, and they're not doing it for you, they're doing it for them. And so they basically make you be too conservative. There are a couple that allow you to control your own investments, and you can be more aggressive, which is really nice because if you figure, I've got my income covered. Even if I run out of cash, I'm guaranteed income for the rest of my life. So why would I want to be conservative with the cash value? I get the same income, either way. And I can get more income if I'm aggressive, and it goes up. So those are the ones I like from the variable standpoint. You can use RILAs, registered index-linked annuities, formerly called equity index annuities. You can use fixed index annuities. You can use fixed annuities. Even using what they call a SPIA, a single premium immediate annuity, can fit in this area, where at that point, if you use a single premium immediate annuity, there is no cash value, but you're guaranteed a payment for usually life if you set it up the right way. And so, but what happens though is if you set these, if you look at the traditional 4% rule, if I could take a portion of my portfolio and put it over off to the side and say, I'm going to get a 6% distribution on this to begin with, 6% of my initial contribution, that means I don't have to have as much from the rest of the portfolio to get to that proverbial 4%. So I can be more aggressive with the rest of the portfolio because now I only need a 2.5-3% distribution from the rest of the portfolio. I can have more money in growth. I can have more money and get a better rate of return. Replace the lower yielding areas and make it work. So first question is, should you consider the lifetime income annuity, the protected income type contract? If you've got more pension and Social Security than you've got expenses, there's no way you should be looking at one of these types of products. And unfortunately, they're sold like they've got these incredible rates of return. And if they're sold to you that you're going to earn 8, 10, 12%, they are lying.
We talked, if you remember, we talked last week. I think it was last week. I'm losing track, but I believe it was about the two most misrepresented, as a term I used, products. And one of these was these annuities. Products.
And lifetime income has to be one of them.
Yeah, and so if you want to hear more about that, you can listen to last week's episode on that.
But if you are in a position where you have more need than direct cash flow, these are something that you may want to consider because it does take a lot of the anxiety off the table, and that allows you to be a better investor with the rest of the money.
Yeah, that's the idea behind that. So that's one of the buckets, and that's the reason you call this a bucket one. Is it 1A? What would you call it?
Well, it's kind of goes against the definition of one because one is a 6 to 7 year time horizon. Yeah. But if you look at, in our world, we read left to right. And so bucket number 1's on the left, bucket number 2's in the middle, bucket number 3's on the right. This bucket is to the left of bucket number one. So it's a pre-bucket number one. I don't want to call it zero, but it's kind of a bucket 1A, but it's not really, because it doesn't have the same definition of bucket of bucket one, because it is lifetime.
Well, that's good. Okay, so that's one of them. And again, if you want to hear more about these types of products, if you're skittish about hearing these words like annuity that Rick Plum is throwing around, have a listen to that, because I think that will probably put your mind somewhat at ease there. I don't know. Okay, so that's one. Now let's talk about the second alternative bucket. And there's that key word right there. I said alternative. The second extra bucket will be alternative investments. Now, Rick, this can get, I don't want this to get complicated, and we're not going to make it complicated. We're going to talk about this more in general terms. But explain, if you would, please, what we mean when we say an alternative type of investment.
Well, when we look at what bucket number 3 is, the traditional investment for bucket number 3 are stock markets investments, whether it be value, growth, small cap, mid cap, large cap, domestic, international, a diversified portfolio of equities, stocks. Typically, you can sell them on any given day, any given minute of any given open day, and you can trade that kind of stuff. Alternatives, on the other hand, are things that are not as liquid. I can't sell them any given minute of any given day. They have different risk characteristics. Not that they don't have risk. I'm not saying that. Mm-hmm. They have different risk characteristics. If you look at the movement of the stock market, go back to it looks more like an EKG, up and down, up and down, up and down, all over the place. Hopefully trending upwards, but lots of up and down, very quick, up and down, fairly steep up and down movements. If you look at alternatives, they tend to have more of a wavelength. They still go up and down. It's just that they're a longer time cycle between up and down. They tend to be more like a wave rather than an EKG, where it kind of flows in, flows out, flows over time. Now, the overall return from alternatives tends to be about the same as the overall return from the stock market. The overall up and down movement can be, similar as well. Up and down, we expect ups or downs to be this or that high. It's just that it doesn't happen as quickly, and they are not as liquid. Real estate, for one thing. You don't see the price of real estate go up and down 1 or 2% a day because, frankly, you're not trying to market it every day. You kind of hold on to it, and you get the cash flow, and you look at it every 4 or 5, 10 years and say, wow, I paid $500,000, it's now worth $600,000. Plus, I got a cash flow in the meantime. I've done okay. And you can then add leverage and other things to try to enhance the return, or screw yourself up if you do it at the wrong time. But so it has. It's not that it's not risky or not volatile. It's different. And so even back in the early days of our original buckets, 1, 2, and 3, for more sophisticated investors, people that took a longer term approach to it, to people who understand a little bit more about investing and can handle the longer term lack of liquidity in some areas, we've been using alternatives, and it was just another subset of bucket number 3. So instead of just having stocks, large cap, small cap, value, growth, there was large cap, small cap, value, growth, and alternatives. And how we used, and alternatives tended to have a larger cash flow, 5, 6, 7% cash flow on an annual basis. How we use that cash flow, we could either reinvest it into more alternatives, or we could dollar cost average it into the market to help take advantage of the volatility that very sharp volatility the stock market has. But the goal was always to maintain a reasonable rate of return, but reduce the overall fluctuation on a day-to-day, week-to-week, month-to-month basis. So it was to reduce the volatility, but still get the same rate of return over time. Some people understood it, some people didn't. And so we've been using it. But then we took a little different approach to it back when interest rates first went into the toilet. And they went to 1% or lower for a number of years. And we said, from this one portion of the overall pie, we're getting a nice cash flow from over here that has been very stable. The valuations go up and down over time, but the cash flow has been pretty stable. So to reduce the amount of reliance on bucket number 1, Because if you're earning 0 or less than 1% on your bucket number one, you have to put more money in there to get the same cash flow out. But if I can use the cash flow from over here, so for a while we carved off part of bucket number 3 into its own bucket and said the asset itself, the principal, is bucket number 3. The principal has to be left alone for a period of time. We cannot count on the principal, but we can use that cash flow to help buffer bucket number 1 so we don't have to put as much money in bucket number 1. So we did that for a while, and now that we've got interest rates back into a reasonable area where we don't have to put as much money into bucket number 1, what do we do with the alternative? We can either continue to use the cash flow, or we can go back to using it to reinvest in itself, or we can go back to reinvesting in the stock market and use it as more of a traditional bucket number 3 allocation, just as a different type from traditional stock investing. So it is a little bit different. It is, like I said, it has a longer term nature. It takes a little bit more sophistication, depending upon how you're doing it. And there are publicly traded alternatives, but you lose some of that, the return aspect of it, because now it trades more like a stock, because you can sell it at any given moment of any given day. Now, it's just sometimes that illiquidity, the inability to sell something just because you're mad at it today, because the news was bad last night. The inability to sell it is a good thing, because a week later, that news has passed and you're back doing okay. A week, a month, a year. Look at real estate. People that buy real estate that are not overly leveraged, that don't lose it because they ran out of money because they have too much leverage, they do okay with real estate mostly because they cannot sell it when it's looking ugly. They're like, I can't sell it now. And I'm never going to sell it for this. But that's a different attitude than stocks. With stocks, it's like, oh, this is a dog. Get rid of it. Boom. I woke up with a bad dream at 2 a.m. and went online and said, sell that dang thing. That doesn't happen with real estate.
It doesn't. And you know something? This is a core factor of this, which is that, I think the asset that most people have that tends to do the best over a long period of time is, like you said, real estate. I'll just say their primary residence, their home. And why is that? Because they tend to keep those assets for longer than 5, 6, 7. In some cases, they keep them for 10, 20 years or more. So what you're saying really rings true. Now, what you said real estate as an example. I can't really give examples of anything, but if we keep this generic, we're not. What type of real estate are you talking about? I think what we're mentioning are like real estate investment trusts. Is that correct?
Well, it can be lots of different types of things. The most common for the non-real estate investor, for the person that doesn't own 42 different individual home rentals, is some kind of a real estate trust where you're not the one picking and choosing where you can buy it for $50,000. But you don't have just one property. You have a series of properties, and it's not you managing it. There's somebody who knows more about real estate, hopefully, managing it. And it's $1 billion worth of real estate, not the house on the corner. And it's amazing when it's an individual property like the house on the corner down the street. Location matters, obviously, but also how good you are at vetting your tenant has a lot to do with whether or not that's going to be a good rental or not. Because I know people that bought real estate projects across the street from each other. They're basically the same house, paid about the same with a couple bucks here or there, and one had a fantastic experience of being a landlord, and the other person just wanted to slit their throats because it was just because they had the tenant from where down below, and
Hades,
and it kept turning over. They were picking the wrong tenants. They didn't have good vetting skills or whatever you want to call it. And their rental turned into a nightmare. The people would, wreck it and then move out. And so now we don't have rent, and we have to fix everything. So we have more expenses and no income. Where across the street, the person had been living there for 3, 4, 5 years and taking care of the place, and there haven't been, these unneeded, unnecessary holes in the wall or things of that nature that they had to fix. And so it's been worked out really well for them. So, and with big real estate projects, REITs for that matter, real estate investment trusts, you can tailor the type of real estate you want to buy. You want to buy data centers? Those are hot topics right now. There's a REIT for that, or there's multiple REITs for that. You want to buy self-storage? You want to buy student housing? You want to buy multi-housing properties? Apartment complexes and things. You want it only in the Sun Belt? You want it only in this area? There's REITs that are doing all these kinds of things, and you can pick and choose. And so, what you want to do?
Okay, so I want to just remind people, though, you absolutely said it's not risk-free. There are
heavens no.
Yeah, very quickly, because we don't have a lot of time left. But
well,
on
if you're
something
looking
like
at these,
this,
you need to look at what the expenses are, what the leverage is, how much they can have for leverage, how much what's going on, what the revenue sharing is between the operating group and the owners, the shareholders, or whatever you want to call yourself. And these are C corporations. It's just the way that they work is a little bit different. So you've got to look at all that, what they're investing and how they can go about investing. And unfortunately, sometimes things that sound really good for unforeseen issues turn into not good issues. Prior to 2020, there were REITs out that invested specifically in 100% in healthcare, hospitals, doctors' offices, things of that nature. And they, up until that point, up until 2020, were very stable. You weren't expecting to grow through the roof, but they were very stable. And then COVID hit, and they got kind of killed. The hospitals actually went out of business, things of that nature. And also, you have to look at what the definition of healthcare was. A lot of these healthcare REITs were using long-term care facilities as healthcare, and we know what happened to some of those during COVID. And so, unfortunately, what looked like a fairly stable potential area to invest turned into not so stable. Office buildings back in the 90s and early 2000s looked like stable places to invest. And then we had the work from home, drive, and office buildings kind of went by the wayside. The ones that look at the real estate that looks interesting now, and see if you can find REITs for that. But like I said, they are not without risk. You have to understand what's going on underneath the surface. Scratch that surface.
So if you're going to do this, and if you're going to do something like alternatives, you would suggest that they work with somebody who has some idea.
Typically, the only way that you can get these are through somebody who actually has access to them, and they're usually typically sold through advisors and brokers.
Yeah. So, but when you're doing these for people, you're aware of the risks. The people who are doing it are aware of the potential risks. Now with bucket three, generally the risk is mitigated over a long period of time, 15 to 20 years, whatever it is, longer. Is that this? Quick answer here: is that the same? Is the same kind of thing mitigated through time with these?
It can be, yes. The whole idea is that the market may be down, and your portfolio may be down, even if it's stocks, it might be down. And as long as you don't sell it to cash and hold on cash for the rest of the time, it'll recover at some point. So if you have these other projects, you may be down in one area, but then if you once you can get out of it, if you get out of it, then you go to another area that has recovery ability. But time usually helps. Now, this is a more sophisticated, different area. You have to know what's going on. You have to know the fees and expenses. It's going to act differently than the stock market, which is one of the reasons you're adding it. But you also need to know that if you're not comfortable with that, don't add it.
Yeah, that goes again back to the whole idea of what are your goals, what are your needs, and if this is not something you need, then certainly don't do it. Well, this is why I wanted to talk about these things, because what this points out, I think, is that having the availability of these extra buckets, these two extra buckets in a bucket strategy, is part of its flexibility. We're talking about adding tools, and that's what these are, when the basic structure, 3-bucket structure, may need some extra support. Now, as we said, the first 3 buckets handle the core retirement income plan, near term, intermediate, and long term. But some people maybe they want, as you said, Rick, a stronger floor of protected income, one that could last their lifetime. Some need to address that longevity risk, additional diversification beyond just stocks, bonds, and cash. and somewhat more flexibility in how their overall plan is built. But that's where some of these ideas of these extra two buckets can come into the conversation. So, but here, what you need to do, as I said, these are tools. They're not starting points. They have to solve a specific problem. If they don't, as Rick just said, they probably don't belong in the plan. And if they do solve a problem, they have to be used carefully. You have to understand, again, the costs, the risks, liquidity, tax treatment, and how they fit with everything else. So make sure you talk this over if you'd like to do this with a qualified advisor, which Rick Plum happens to be, by the way. You want to talk through how the bucket strategy and maybe these other one or two of these other buckets might apply to your own retirement plan, or whether these belong in your plan. Talk to the advisors at Lucia Capital Group, 800-644-1150, 800-644-1150. They've been doing this stuff for a long time. You can also visit online, luciacap.com. And by the way, I mention these guides every week. I try to anyway. If you download the bucket, I think it's the Bucket Strategy Guide, I'm pretty sure, has this kind of laid out in a grid for you. And it will explain these other two buckets, how they're composed and who may need them. A lot of what Rick just happened to say. So if you want to go to luciacap.com, type that in the search bar, Bucket Strategy, and you should be able to see it and download it right there. There's also a Social Security guide, estate planning guide, and much more than that. So search bar on the website, download whatever is helpful to you. Make sure you subscribe to the podcast, Apple Podcasts or Spotify, so you do not miss an episode. We love talking about strategies. We like talking about rules, planning decisions that can help you manage your financial future, and that's exactly what we do right here. Rick, you are outstanding today. Can I say that again? Can I give you an A+ for today?
Do I have to pay you again?
This may be a freebie. I don't know. Well, I'll see. We'll check. Thank you. I do appreciate that. This was outstanding. For Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor, I'm your podcast host, Johnny Dean. Thanks for listening. We will talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. The information provided is not intended as tax or legal advice. Always consult a tax or legal professional for specific advice regarding your individual situation. There's no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principals. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. A dollar-cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. Asset allocation does not ensure a profit or protect against a loss. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. Investments in non-traded real estate investment trusts, or EITs, are subject to significant risks. These risks include, but are not limited to, limited operating histories, reliance on the advisors, conflicts of interest, payment of substantial fees to the advisors and their affiliates, and illiquidity. Investments in real estate may be subject to a higher degree of market risk because of concentration in a specific industry, sector, or geographical sector. Other risks can include, but are not limited to, declines in the value of real estate, potential illiquidity, risk related to general and economic conditions, stage of development, and defaults by borrower. Variable annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59 and a half, may be subject to an additional 10% federal tax. Certain terms and conditions apply, so please read insurance company materials carefully. Equity indexed annuities, registered index-linked annuities, are considered complex investment products. They contain unique features, risks, terms, conditions, fees, charges, and expenses. Fixed indexed annuities are complex long-term investments designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Withdrawals may be subject to surrender penalties or foregoing benefits if withdrawn prior to the contract term. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Long-term care coverage policies and provisions may not be available in all states. Approval may be subject to the terms and conditions of the insurance company. Insurance product guarantees are subject to the claims-paying ability of the issuing insurance company and are subject to their terms and conditions. Stock investing includes risks including fluctuating prices and loss of principal. principal. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Past performance does not guarantee future results. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License number 0518721. LPLIA California Insurance License number 0B91442.